Imagine walking into your bank tomorrow, expecting to withdraw the cash that you've worked so hard to deposit into your account. But instead of receiving the funds, you're told that the money simply isn't there. You try to withdraw all of it, but the bank can't give you a cent. Now, this may sound like the beginning of a dystopian novel or an unlikely financial crisis. But here's the thing, it's not just fiction. This is the reality. The money in your bank account doesn't actually exist in the way you think it does. This system that holds your money together, it's a trick, one that most of us don't see because we've come to accept it as normal. It's called fractional banking, and it's the engine that powers global debt, inflation, and the illusion of wealth. Banks, by design, are allowed to lend out far more money than they actually hold in reserves. And yet, for the most part, we continue living in a world where the numbers in our accounts seem to be real. Today, we will dive into how money is created out of thin air and how this invisible system, based on trust and promises, drives the entire global financial system. When you deposit money into a bank, the assumption is that the funds are sitting safely in a vault, waiting for you to access them whenever you need. But the reality is quite different. Instead of holding your cash in reserve, the bank only keeps a small portion of your deposit in its vault. The rest, it's lent out to other people, to businesses, or to individuals buying homes or starting companies. You see the problem yet? This is what we call fractional banking. The catch, however, is that when your money is lent out, it doesn't physically exist anymore in the way you think about money. It's essentially numbers on a screen, a virtual existence backed only by trust. The practice of fractional banking actually goes back centuries, to a time much earlier than we might think. It traces back to medieval Europe. Back then, gold and silver were the primary forms of money. If you were wealthy, you would keep your coins in a chest or store them with a goldsmith. Goldsmiths were trusted individuals who kept valuables safe in secure vaults. Seems safe enough, right? In exchange for this service, the goldsmith would issue a receipt, a simple note that promised the bearer could return and claim their gold. These receipts were the early form of paper money, and they had one distinct advantage. They were much lighter and easier to carry than actual gold. But here's where the trick began. The goldsmiths soon realized something very interesting. Almost no one came to claim their gold all at once. It wasn't a problem. If they had, say, 100 customers with deposits, only 1 or 2 would actually come to claim their gold on any given day. This left the vast majority of the gold sitting unused in their vaults. It was a golden opportunity. So the goldsmiths began issuing more receipts than they actually had gold to cover. In other words, they printed more money than they had in reserves, and they loaned it out to people for interest. The goldsmiths didn't see any immediate danger in this because they were confident in the system. They knew the odds were that only a few people would come to redeem their gold at any given time. And as long as everyone trusted the system, it worked. More receipts were created, and the goldsmiths earned money by charging interest on gold that didn't really exist. As you can imagine, this practice gradually evolved into the banking system we know today. By the 17th century, the first formal banks began to emerge. One of the first was the Bank of England, which was created in 1694, not to serve the public, but to help the British government finance endless wars. The government borrowed money from the bank far beyond what it actually had in gold, and repaid those loans through taxes. Over time, this system of borrowing money that wasn't really there became more widespread. The practice continued into the early days of the United States, where banks issued banknotes that were supposed to be redeemable in gold. But once again, the same problem arose. Banks quickly realized they could print more notes than they had gold to cover. And as long as people weren't all asking for their gold at once, everything seemed fine. But eventually, as with the goldsmiths of the past, the system collapsed when a large number of people rushed to withdraw their money at the same time. The panic spreads quickly. People realize the truth too late. Bank runs expose the fact that the money simply wasn't there. The illusion of stability shatters. Entire banks collapsed overnight. In that moment, everything changes. Instead of dismantling the system, however, governments doubled down on it. They created central banks to backstop the illusion. Even if the money didn't actually exist in physical form, governments and banks would make sure that the public continued to believe that it did. And so the cycle continued, with central banks like the Federal Reserve in the US or the European Central Bank stepping in to ensure the financial system stayed intact, no matter how fragile it might be. Today, fractional banking operates under a new set of rules. Instead of requiring banks to hold a certain percentage of their deposits in reserve, as was once the case, the reserve requirements are now effectively zero. This means that banks can create an unlimited amount of money through loans, and they don't need to hold any reserves against them. This may sound like a recipe for disaster, but in reality, the system has been carefully designed to keep it running smoothly for as long as the public continues to trust it. When you take out a loan from a bank today, you're not borrowing money that's been sitting in a vault somewhere. No, you're borrowing newly created money. The moment the bank approves your loan, that money is created and deposited into your account. It didn't exist before, but now it does. And the only reason it exists is because you've agreed to pay it back with interest. Essentially, every new dollar in the system is born out of debt. But here's the real kicker. Only a tiny fraction of the money circulating in the economy actually exists as physical cash. The rest is debt that must be repaid with interest. Banks lend money into existence, and every loan creates more money, more debt, and more obligations to pay it all back. This process of money creation is what keeps the global financial system running, but it's also what leads to the constant expansion of debt and inflation. Now, let's step back and think about the long-term consequences of this system. Inflation, which we all experience when prices rise, is built into the design of the banking system. Since banks are always lending more money than they actually hold, the value of each individual dollar decreases over time. Prices go up, not just because of supply and demand, but because there are simply more dollars in circulation, and each one is worth less. This constant expansion of debt and inflation has serious consequences for all of us. For the average person, wages stagnate, and the cost of living rises. It's a frustrating reality that many can't escape. The rich, on the other hand, are able to benefit from inflation. They own assets like real estate, stocks, and commodities, which increase in value as inflation pushes prices higher. Meanwhile, the average worker finds their wages losing purchasing power, unable to keep up with the rising costs of living. The system, in essence, is designed to favor those who own assets, while leaving the rest of us trapped in the cycle of debt. The system also depends on governments to keep it running. Governments borrow money from central banks, which creates new debt that must be repaid through taxes. The problem is, as we continue borrowing more money than we can ever realistically repay, the cycle becomes harder to break. In the past, when banks ran out of money to lend, the system could collapse. But today, central banks just print more money, ensuring that the cycle continues, albeit at a cost. Inflation rises, and wealth is concentrated in the hands of those who own the assets. What's even more concerning is that this system doesn't just benefit the wealthy, it's actively designed to create inequality. As the system grows, the rich get richer, while the average person struggles to make ends meet. The debts accumulate, interest piles up, and it becomes almost impossible for most people to escape the cycle. This leads us to a crucial question. Is there any way to break free from this cycle? The answer lies in shifting our perspective on what constitutes real wealth. Money, as it exists in the current system, isn't real wealth. It's just a tool. True wealth lies in assets that have lasting value. Land, real estate, businesses, and skills that are not tied to the unstable money created by banks. To escape the system, we must begin to build wealth outside the traditional financial system. This is not just a suggestion, it's a necessity. Instead of relying on bank-created money, we need to invest in tangible assets, things that have intrinsic value and can't be devalued by inflation. Real wealth doesn't come from having money in a bank account or investing in stocks and bonds that are tied to the same debt-based system. It comes from owning things that hold value when the system begins to crumble. So, what can you do to protect yourself from this fragile system? First, educate yourself about how the system works. Understand that money is not wealth, it's just a tool. Once you grasp this, your entire approach to money will shift. Build your wealth in ways that are not dependent on the constantly expanding web of debt. Invest in things that hold real value, like land, real estate, and businesses. These are assets that will remain valuable, even as the financial system falters. The key to financial freedom is not in accumulating money, but in stepping outside the system that creates it. Money, as it exists today, is just an illusion, a promise made by banks and governments that can never truly be kept. Once you understand the trick, you can begin to build wealth that's outside the reach of the system. And in doing so, you can protect yourself from the inevitable collapse that will come when the system finally breaks. If this perspective has changed the way you think about money and wealth, consider subscribing. History holds the answers to understanding the true nature of our financial system, and I'll show you where to look.